Welcome to Breaking News to Trading Moves.
Today we're looking at a key development out of Washington, D.C. Funding lapsed just after midnight, 12:01 a.m. Eastern Time, and that's triggered a U.S. federal government shutdown.
Yeah, and these shutdowns, they always change the landscape, at least temporarily for a lot of businesses. Some face immediate roadblocks, others might actually find some advantage.
That's right. So our job today, for you listening, is really to work through the analysis we've prepared. We're pulling it together to map out which specific groups, which companies, the data suggests, could gain or lose ground because of this policy disruption.
Exactly. We're focusing purely on explaining that analysis, the predicted market reactions, where the pressure points are, which sectors feel this shutdown directly, and which ones maybe offer some kind of defense against the instability.
And just to set the scene, the initial analysis we looked at shows, well, immediate and pretty concrete strains across the economy. This isn't just theoretical market jitters. It's hitting logistics.
Right, real-world impact.
Yeah. We're talking about strain in aviation. Basically, you think the FAA's operations getting squeezed, government data releases, permits, those get delayed. And then there are interruptions in housing deals, payments to federal contractors. It's quite broad.
So these are the first places where policy failure turns into actual business problems. Friction.
Precisely. That's the starting point.
Okay, so when things get uncertain in Washington, like now, money looks for safer places to hide. That's the standard playbook, right? So the analysis we have suggests certain sectors benefit, not because they're doing anything new, but just because they're seen as insulated from the mess.
That's the idea. It's about offering insulation.
Let's start there. Where does the research point for potential beneficiaries when policy gets unpredictable like this?
Yeah.
Why does a procedural failure actually help some established sectors?
Well, the main driver here is increased volatility. That plus what investors often call a flight to quality. When the immediate path forward for government funding for essential paperwork becomes unclear, investors tend to quickly back away from higher risk assets. Growth stocks maybe take a hit.
And they pivot instead towards
capital preservation. They want stability. This shift creates what the materials we reviewed call risk-off flows. Basically, portfolio managers start paying a premium for certainty wherever they can find it.
Okay, got it. So first up in the analysis, precious metals miners. I think most people get why gold is seen as a safe haven, but how does a domestic government shutdown specifically help these mining companies? Is it the same as, say, a global crisis?
It's similar, but with a specific domestic flavor. The core idea is that this kind of political uncertainty happening right here boosts demand for assets seen as detached from that policy risk. Gold is a classic example, obviously.
Right.
But the mechanism here is a bit more specific. When Congress can't manage its most basic task, passing a budget or a continuing resolution, it raises deeper worries. Concerns about its ability to handle future fiscal challenges, like the debt ceiling down the line.
So the market reads this inability to pass a simple funding bill as maybe a sign of bigger governance problems to come. And that fear pushes money into gold.
That's exactly the thinking outline. The analysis highlights that the volatility that flares up around these events makes investors hedge, sometimes even against the dollar itself. Gold often serves as that counterweight.
And the miners?
The miners benefit directly because the price of what they sell gold tends to go up during these periods. Their potential revenue increases without any change in their own operations.
Okay, so which specific companies are highlighted in the analysis as being positioned for this? And how tightly are their stocks linked to the gold price itself?
The material pointed to two major players offering broad exposure here. First is Newmont, the ticker is NEM.
NEM.
And the second is Barrick Gold, ticker GOLD.
GOLD. Easy enough.
Yeah. And for companies like these, the correlation is usually very strong. Their profitability is really sensitive to movements in the spot price of gold. If political gridlock pushes gold up, say, a few percent, these stocks typically react positively, often quite substantially.
Making them direct beneficiaries of those policy-driven risk-off flows we talked about.
Exactly.
All right, moving beyond miners, the research also points to defensive sectors, utilities and consumer staples. These are the classics, known for reliability. But why would a government shutdown make them outperform the broader market? They aren't usually growth leaders.
No, they're not growth leaders.
Yeah.
But like you said, during a disruption like this, growth isn't really what investors are prioritizing. They're looking for reliability.
Predictability.
Precisely. And the data we reviewed suggests that in these risk-off tapes, as they're sometimes called, defenses tend to get more support relative to the market.
Yeah.
Why? because investors want earnings stability above almost anything else.
And the logic is simple.
It's pretty straightforward. Whether the government's open or closed, whether permits are being issued or not, people still need to heat their homes. They still need electricity. They still buy toothpaste, groceries, basic household goods.
Right. That insulates their earnings from the bureaucratic slowdowns hitting other sectors.
Exactly. Policy disruptions create noise, risk, uncertainty about cash flow, especially for sectors relying on discretionary spending or quick government approvals. But utilities, consumer staples, their business is based on things people have to buy.
Non-negotiable spending.
Right. So their earnings forecasts tend to hold up relatively well, even when overall economic policy is up in the air. The analysis mentioned Duke Energy ticker DUK for utility
The UK.
and Procter & Gamble ticker PG as a key example in consumer staples.
PG, okay.
Their business models are just inherently less exposed to the immediate friction caused by federal furloughs.
Okay, that makes sense. Now, the third category of potential winners mentioned is maybe less obvious. Market infrastructure and volatility plays. Exchanges, clearinghouses. Why would a slowdown or policy mess actually help the companies that run the trading systems? Wouldn't uncertainty make people stop trading?
Yeah, that's the counterintuitive part. But uncertainty doesn't necessarily stop trading. Often, it actually increases it.
Really? How?
Well, when headlines are flying around, unpredictable, volatility spikes. And that instability often leads to much higher trading volumes. You have institutional investors rushing to rebalance portfolios, hedge their bets, or make quick tactical trades based on the news flow.
Okay, so more activity.
More activity, and crucially, it also tends to boost derivatives trading. Futures, options products, specifically designed to play on or protect against expected price swings. That market gets very active.
Ah, so the companies providing the venues, the exchanges themselves, they actually make more money because more transactions are happening and maybe more complex, higher fee products are being used.
That's precisely the mechanism described. It's like a windfall from transaction fees.
So who benefits here, according to the analysis?
The research highlighted Cboe Global Markets, ticker CBOE.
CBOE.
They're heavily linked to volatility. They host the VIX index, the fear gauge, and are huge in options trading, and also Intercontinental Exchange, ticker IECE. They operate numerous global exchanges and clearinghouses. Both are set up to potentially collect higher fees and see revenue bumps when trading volume and hedging activity surge because of policy instability. Market fear itself effectively becomes their product.
So pulling together the winner's side based on this analysis, it looks like capital moves towards things the government doesn't directly control: gold, basic necessities, and also towards the platforms where the resulting market anxiety gets traded. A clear preference for liquidity and insulation from policy risks.
That seems to be the core takeaway from that part of the material, yes.
Okay, let's pivot now. Let's talk about the groups and sectors that are expected to feel the pressure, face downward trends, or immediate operational problems because of this federal pause. This is where the shutdown hits home because their revenue is often tied directly to government functioning.
Right.
And the first one is pretty visible to anyone who travels: airlines and airports.
Yeah, the immediate issue here is staffing. And critically, it's about essential employees having to work without immediate pay. That impacts morale, efficiency, and potentially safety down the line.
How so?
Well, the analysis details that the FAA, the Federal Aviation Administration, is set to furlough over 11,000 employees. Now, crucial staff, air traffic controllers, TSA agents, they have to keep working. Safety demands it.
But they aren't getting paid on time.
Exactly. Their paychecks are delayed until the shutdown ends and funding is sorted out. So while they're on the job ensuring safety, there's understandable strain. Morale takes a hit.
And what does the airline industry expect from this situation, even if the essential people are physically there?
The warnings we reviewed from industry groups are pretty clear. Expect operations to slow down. Expect reduced system reliability. Potential disruptions for travelers that go beyond just the control tower.
How? What kinds of things?
Well, think about systems maintenance, regulatory oversight work, certifying new equipment, long-term planning. A lot of that is done by FAA staff deemed non-essential who are now furloughed. So you get a backlog building up. It strains the whole operational environment. And even for those working unpaid, efficiency can naturally dip because of the financial stress and, frankly, the distraction.
And any delay in air traffic control or extra time in security lines, that ripples through the whole system, right? Causing delays everywhere, increasing costs for airlines, hitting their performance metrics.
Absolutely. The strain becomes systemic. The research specifically mentioned Delta Airlines, ticker DAL, and United Airlines, ticker UAL, as examples of stocks facing this direct operational and regulatory headache. They face higher costs from delays, potential damage to passenger trust if things get unreliable.
Okay. Next area identified is travel and lodging near national parks. This feels a bit more specific. I think a lot of people assume the parks just shut down completely. Is that right?
That's a common misconception and a really key nuance. The policy usually is that national parks are kept mostly open.
Mostly open.
Yeah, people can often still get in.
Yeah.
But, and this is the crucial part, it's with drastically reduced staffing and severely limited services.
What kind of services?
Think about everything that makes a park visit work smoothly. Visitor centers, gift shops, maintained restrooms, trash collection, even park rangers for safety or rescues. Many of those staff are deemed non-essential. They get furloughed.
So you might be able to drive in, but the experience is diminished. Maybe less safe, amenities gone.
Exactly. Degraded experience, potential safety worries with fewer staff around, basic facilities might be locked or unmaintained.
And how does that hit the big hotel companies operating nearby? Does it translate directly into losses for them?
Yes, and we have pretty clear historical data on this from past shutdowns, according to the materials we reviewed.
Okay.
The analysis showed that when amenities disappear and these safety or sanitation concerns pop up, people cancel trips en masse. If you planned a big family vacation around, say, Yosemite or the Grand Canyon, and suddenly the roads might be closed, facilities locked, no ranger programs, you likely cancel.
Right.
And that directly impacts the major hotel chains with properties right near these popular parks, especially during peak seasons.
And the companies listed in the analysis aren't small local motels. These are major brands, so the impact is potentially quite material for them.
That's correct. The analysis mentioned Marriott, ticker MAR,
MAR.
and Hyatt, ticker H. While they obviously have global operations that provide some cushion, their properties' new major U.S. national parks become very vulnerable to this sudden drop-off in bookings when shutdowns hit. It's a direct hit to near-term revenue for those specific locations.
Okay, let's shift to the housing market now. Home builders, mortgage originators. This is a huge part of the economy. Why does a government funding gap slam the brakes on companies like, say, Lennar or Rocket companies? Aren't they mostly driven by interest rates and overall housing demand?
They are, but there are two very specific, very direct ways a shutdown hits them, both tied to essential federal programs that grease the wheels of the housing market.
Okay, what's the first one?
The first, and maybe the most immediate showstopper, is the lapse of the National Flood Insurance Program. The NFIP. This is the main federal program for flood insurance. When its authorization lapses, they immediately stop issuing new policies.
And why is that such a big deal? Why does that stop at house sale?
Because if a property is in a designated flood zone, and a lot of properties are, you generally cannot legally close the sale without having flood insurance in place. Lenders require it. So if you can't get a new NFIP policy, closings in flood zones across the entire country just stop instantly. It's not a slowdown. It's a hard stop for those deals.
Wow, okay. That's a serious blockage for builders trying to sell homes and for mortgage companies counting on those closings. What's the second mechanism affecting housing?
The second is a more general but still significant slowdown in processing federally backed loans. We're talking FHA loans, Federal Housing Administration, and USDA loans, often used in rural areas.
Right. Important programs, especially for certain buyers.
Very important. And these programs rely heavily on federal staff for reviewing applications, processing paperwork, giving approvals. With furloughs, staffing is reduced, non-critical functions pause. So the whole approval pipeline slows down considerably.
Which frustrates buyers waiting for financing and lenders who need that volume.
Exactly. It gums up the works.
But let's say the shutdown only lasts, I don't know, a couple of weeks. Would that FHA delay really be a major risk for a huge builder like Lennar? Isn't it just a temporary blip?
That's a fair question, but the analysis suggests even a short shutdown is material for a couple of reasons. First, that NFIP blockage is immediate and total for affected properties. It's not a delay, it's a stop. Second, the FIUSDA slowdown hits thousands of transactions all at once, especially impacting first-time buyers or those with lower incomes who disproportionately rely on these programs. Builders need a consistent flow of closings to meet quarterly numbers. Mortgage originators depend entirely on loan volume. Even a temporary halt creates an earnings gap that's hard to fill quickly.
So the pressure hits the builder's immediate revenue recognition and the originator's volume metrics. The companies identified here facing this pressure were Lennar, ticker LEM.
LEN, one of the biggest builders.
And Rocket Companies, ticker RKT.
RKT, yeah, a major mortgage originator, especially sensitive to FHA processing speeds.
Okay. Finally, the most direct hit, it seems, federal IT and services contractors. I mean, their main client is the government.
Exactly. By definition, these companies rely on government contracts for their bread and butter.
This must be an immediate financial headache for firms whose customer just partially closed.
It's a direct and pretty severe financial strain. The research explains that work on many contracts considered non-essential just stops instantly.
Like what kind of work?
Could be developing a new IT system, running certain data centers, providing long-term analysis. Anything not deemed absolutely mission-critical right now gets put on hold.
Okay.
But maybe the most critical piece for these publicly traded companies is cash flow, even for contracts that are allowed to continue because they are essential. The payments from the government for that work, they get suspended, delayed, could be weeks, could be longer, until funding is back online.
Wow. So they might still be doing the work, but the money stops coming in. That puts huge pressure on their cash, especially if they have big payrolls, infrastructure costs they still have to cover.
Absolutely. Huge pressure. Their near-term revenue forecasts get hit immediately. They have to keep their skilled staff employed, ready to go back to full speed the minute the government reopens. But the revenue and the cash inflow are just blocked or delayed.
And the analysis names some big players here.
Yes. Large contractors with significant federal exposure across different agencies. Leidos, ticker LDOS.
LDOS.
And Booz, Allen Hamilton, ticker BAH. Their financial performance is just fundamentally tied to the government functioning smoothly and paying its bills on time.
Okay, so we've walked through the analysis of the potential winners driven by safety, stability, or volatility, and the losers hit directly by operational ties to federal functions and payments. Let's try to pull this together. What are the main tactical takeaways from this analysis for you, the listener?
Well, the general market expectation outlined in the material is for choppy opens and headline risk. Basically, expect bumpiness as long as this policy situation lasts.
Which naturally favors a more defensive stance.
Right. That's the environment that tends to reward defensive positioning.
So what does that defensive posture look like, practically speaking, based on the research we've covered?
The strategic suggestion is to lean towards those defensives in precious metals, especially if that risk-off feeling really picks up steam, meaning favoring the stability you get from utilities, like Duke Energy, DUK, or consumer staples, like Procter & Gamble, PG. And certainly keeping an eye on gold exposure through miners like Newmont, NEM, or Barrick Gold, GOLD, particularly if it looks like the shutdown might drag on. The longer it lasts, the more valuable that stability becomes.
And what about that volatility trade, the one involving the exchanges, CBOE and ICE?
Yeah, the suggestion there is more tactical, looking for opportunities linked to the volatility itself through those market infrastructure companies. CBOE Global Markets, CBOE, and Intercontinental Exchange, ICE.
Because when the market is jumping around on news?
The platforms where people trade that uncertainty, especially options and futures, tend to see more business. More volatility equals more transaction fees for them.
Okay. Now, for you listening, if you're actively tracking things day to day during this shutdown, what specific things should you watch beyond just the stock prices to get a real-time sense of these sector impacts? Where is the confirmation?
The research gives some really concrete pointers here. For airlines, it says track public flight statistics, on-time performance, delays, and also the official TSA throughput numbers.
Why those specifically?
Because if you see a measurable jump in system-wide delays, or if airport security processing times start to climb noticeably, that's a real-time indicator of the operational strain from furloughs and unpaid staff hitting home. It validates the pressure on companies like Delta, DAL, and United UAL.
And presumably keep an eye on official FAA announcements, too.
Oh, absolutely. Monitoring official FAA communications about any capacity constraints, operational advisories, maintenance issues, that's crucial for gauging the near-term environment. Any public signal of degraded operations would likely increase perceived risk for those airline stocks.
Makes sense. And finally, for the housing sector, given those specific bottlenecks around flood insurance and loan processing.
There, the advice is to track commentary coming from major lenders.
Right.
Are they talking publicly about closing delays? Also, watch housing data releases, specifically mentioning the National Flood Insurance Program, the NFIP, or slowdowns in FHA loan processing.
So if lenders start warning widely about deals getting stuck in flood zones because of the NFIP lapse?
That's direct confirmation that the pressures analyzed for builders like Lennar, LEN, and originators like rocket companies RKT are actually playing out in the real world. It shows the policy disruption is creating real transactional hurdles. These metrics give you a grounded way to check the analysis against reality. And maybe a final thought, just based on all this material we've discussed, for you to consider. Think about the unique vulnerability of companies whose entire business model depends directly on non-essential government work, like those big IT contractors, Elders and BAH. Their revenue stream can literally be shut off like a tap because of political disagreement. Now, contrast that with sectors like utilities or consumer staples, where the demand for their products just persists. People need power, they need soap, regardless of what's happening in Congress. That provides a powerful buffer.
A very different kind of exposure to policy risk.
Completely different.
Okay. Please remember, this analysis does not constitute financial advice or recommendations to buy or sell any security. This discussion is purely the opinion of the author of the material we have reviewed. Thank you for joining us for this look at the market implications on breaking news to trading moves. We look forward to speaking with you again soon.